Can the stock market really make you rich, or is that just hype? In this video, we'll break down the truth behind stock market wealth, real strategies that work, and common myths to avoid. If you're serious about growing your money, like, subscribe, and let's uncover the facts together. When people think of building wealth, the stock market often comes to mind. From Wall Street movies to stories about everyday people becoming millionaires through strategic investing, the stock market has long been seen as a path to financial success. But is this vision rooted in reality? Can the average person, not a hedge fund manager or day trading genius, really get rich from the stock market? 1. Understand how the stock market works. To succeed in the stock market, the first step is to educate yourself. Many people fail because they enter the market with unrealistic expectations or poor understanding. The stock market is not a place for blind bets or quick gains. It's a platform where businesses raise capital and investors share in their success. When you purchase shares, you're buying partial ownership in a company, which entitles you to benefit from its profits through two primary means: capital gains, price appreciation, and dividends, profit distributions. By learning basic financial terms, how companies are valued, and how market trends work, you set a solid foundation for investing wisely and avoiding costly mistakes. 2. Focus on long-term investing, not short-term trading. One of the biggest secrets of stock market wealth is adopting a long-term mindset. The stock market can fluctuate dramatically in the short term due to news, politics, or market sentiment. However, over longer periods, history has shown that markets generally rise. For instance, the S&P 500 has delivered an average annual return of about 10% over the past century. Those who attempt to time the market often buy high and sell low out of fear, missing out on the market's eventual recoveries. In contrast, long-term investors ride out volatility and benefit from compounding growth. The key to getting rich isn't daily trades, it's staying invested and letting time and growth do the heavy lifting. 3. Start early and invest consistently. Time in the market beats timing the market. The earlier you begin investing, the more time your money has to grow. This is due to the power of compound interest, where your earnings generate their own earnings. Even small, regular contributions, such as $100 or $200 a month, can accumulate into substantial wealth over 20 to 30 years. A person who starts investing at age 25 and stays consistent can end up with a far larger portfolio than someone who starts at 35 and invests the same amount. The magic lies in consistency. By automating your investments and making it a regular habit, you create a snowball effect that accelerates over time. 4. Diversify to minimize risk and maximize growth. Another critical step in getting rich through stocks is diversification. This means spreading your investments across different companies, sectors, and even asset types. If you put all your money into a single stock and it crashes, your portfolio could be devastated. Diversification protects you from this by balancing losses in one area with gains in another. You can achieve this through mutual funds, exchange-traded funds, ETFs, or simply building a portfolio with a range of companies. Diversification not only reduces risk, it also stabilizes your returns and gives you peace of mind. When you're diversified, you're not betting on one winner, but participating in the overall growth of the market. 5. Keep learning and stay informed. Even the best investors never stop learning. The stock market is dynamic, influenced by global events, policy changes, and evolving industries. As an investor, staying informed about the companies you invest in, reading annual reports, watching market trends, and understanding economic indicators can help you make smarter choices. Educate yourself on key metrics like earnings per share, return on equity, and price-to-earnings ratio. Listen to expert podcasts, read investment books, and follow reputable financial news. The more you understand, the better equipped you are to seize opportunities and avoid pitfalls. Knowledge is your most valuable asset in the journey to financial independence. 6. Master your emotions to avoid costly mistakes. Stock investing is not just about money, it's about psychology. Emotions like fear and greed often drive poor decisions. When markets crash, fear can lead to panic selling. When markets soar, greed can push you to chase hype and overpay for stocks. Emotional investing undermines long-term strategy and leads to buying high and selling low. The most successful investors develop emotional discipline. They follow a plan, stick to their strategy, and don't react impulsively to short-term noise. By staying calm during downturns and avoiding the herd mentality, you protect your wealth and make decisions based on logic and long-term goals. 7. Reinvest dividends to accelerate growth. Dividends are a powerful but often underestimated tool for building wealth. Some companies share their profits by paying dividends to shareholders. When you reinvest these dividends instead of withdrawing them, you buy more shares. Over time, those additional shares also earn dividends, leading to exponential growth through compounding. Many brokerages offer dividend reinvestment programs, DRIPs, that automate this process. This seemingly small decision can dramatically increase the value of your portfolio over decades. Especially when investing in stable, dividend-paying companies, reinvesting dividends can quietly and steadily multiply your wealth. 8. Set clear goals and track your progress. Finally, getting rich through the stock market requires direction. Investing without a goal is like sailing without a destination. Do you want to retire early? Buy a home? Build generational wealth? Your goals will shape your strategy, how much you invest, where you invest, and what risk you're willing to take. Setting clear, measurable goals helps you stay motivated and disciplined. Additionally, tracking your progress ensures your investments stay aligned with those goals. You might adjust your portfolio, increase your contributions, or rebalance your assets based on performance and changing circumstances. Goal-based investing makes the process more focused and results more achievable. Yes, you can build wealth in the stock market, but it takes patience, strategy, and the right mindset. If this helped shift your perspective, like, subscribe, and drop a comment with your biggest takeaway. Stay smart, invest wisely, and I'll see you in the next video.